a panel, bit of an educational thing. So today we've gone with a finance panel. So today we've got our mortgage broker here, our accountant, financial planner, and our asset broker as well. So the idea behind this is I've got a few questions. They're all going to have a different perception of how things should be answered. So that's the idea behind it. Not everything's the same in every industry, and it's viewed differently from each thing. So I've asked the guys to sort of answer the questions the way they see it from their industry and what they sort of do. And hopefully we can all learn something from it. So we've got experts here in the room, so try and pick their brain on a few things. So I'll get straight into it. So I guess this is an open one from the panel. We'll start with yourself, Tim. What would you say the biggest financial mistake?
Where's Tim Gord?
Oh, sorry.
Sorry, getting your customer's name wrong.
What would you? Biggest financial mistake you see business owners make, and how can they avoid them?
Don't pay tax.
Don't pay tax.
Especially when they want to borrow money. They
There you
come
go.
in with no concept of what they're doing, why they're doing it, but I don't pay tax, but I make all this money. Well, if you don't pay tax, then you're going to pay a higher interest rate. You're going to have to go to something like a low doc loan, a no doc loan, or something like that, and you won't get the finance that you need, basically, with all that. The other thing that you find that they make a mistake is they don't know their numbers and they don't understand what their expenses are. And that's a big one.
Beautiful. There we go. Ish.
I think people get confused with different taxes, and they think whatever they're paying to the tax office every quarter or every month does not mean they've paid their income tax. There could be tax like simple as a GST, or sometimes the bigger companies pay FBT, and there's a payroll tax for the state government. So with all those taxes, yes, they're for a different purpose, but we all need to understand, especially the GST is not your money. It's all you're really doing is you're collecting on behalf of the tax office and just giving it. You just basically, a business is just a collector in the middle. And I think that's where a lot of people get confused with the taxes.
Yeah, okay.
So it's the biggest mistake in business.
Yeah. So what do you find is the biggest mistake business owners make?
I think emotions. A lot of people make decisions on particular emotions. So not getting, really coming back to your purpose and your thing in life. So making informed decisions and trying to take emotions out of before you make them decisions. Because like people will go and, my neighbour's got a self-managed super fund. I'll go and set up a self-managed super fund, or do this and do that. But it's really understanding who you are, your purpose in life, where you want to get, and making informed decisions and trying to not get caught up in emotions of the decision.
Yeah, okay.
My take is touched on what Tony said earlier about GST registration.
Yep.
One of the first questions that I've got is how long has the business been going and how long has it been GST registered?
Yep.
Because when it gets to 2 years GST registration, a lot of the financiers have the understanding, or their criteria is that that particular business owner knows what he's doing by now.
Yep.
So we can get past the financials, those sorts of things, makes a job a lot easier. I've also had those conversations with clients that have got small business. Doesn't matter whether you're GST registered or not, you're going to pay the same amount of tax anyway.
Yeah.
So for God's sake, get GST registered. Makes our job easier, that's for sure.
Yeah.
And then have an account.
Yeah. So, leading it, what should every business owner have in place applying for finance? So I guess we'll start from a business or personal point of view. We'll start with the mortgage broker is the best one.
The financial's done.
Yeah,
Financial's done, yeah.
And up to date.
And up to date, yeah.
Yeah.
So if it's coming into August, October, and you want to go and buy it, and you've had a good year in the 25 year, your 24 year mightn't have been as good, but you get a good year, go and get your financials done.
Yeah.
And, ask your accountant to make them work and get them done. Get your tax up to date. Get your ATO payments up to date, all those sort of things.
Yeah,
Because
when they've got their financials, they've got a fair idea whether they can afford it.
Exactly.
It's pretty important.
It is very important.
Yeah.
What about yourself, Ish?
I think the financials are the key thing, and especially as you mentioned, if you had a good year as 25, the banks might be just happy to look at 25. Why not pay a little bit of tax? At least you're going to get a better rate on the loan for a long term, rather than going for a second-tier lender or a third-tier lender where you're going to pay a higher rate because you don't want to pay the tax. Tax would be only 10 grand, but that interest on a mortgage of $400,000 or $500,000 is going to be a lot more over the lifetime.
Yeah.
Can you just repeat that again? There's a question.
Yeah, of course, mate. What should every business owner have in place before applying or looking for finance, business or personal?
Yeah,
regardless?
I suppose from a financial planning point of view, again, I often get people come to me and say, okay, the bank's going to give us $1 million loan, or we're going to give you this and that. But when you sit down with the individual person, the bank's already given, said, okay, we're going to give you $1 million, but can you really manage that money yourself? Can you manage that commitment? Is that commitment, do you really want to tie yourself to, a lot of people say, I want to own a house because that makes me happy. But and the bank can give me $1 million loan and I want to own a house. But when you really dig deep and start talking to the conversations with people and say, okay, your payments are going to be X amount of dollars, you've got rates, you've got insurances, you'll have to get a second job to be able to meet these payments. A lot of them, when you really dig deep, they think they want to own a house, but they don't want to own a house when it comes to all the emotional pressure of it. So for me, getting making sure that fits your goals or your purpose in life.
And a lot of lenders have moved across from financials because that's the old news. That was like 2 years ago.
Yeah.
Whereas bank statements, transaction lists, that sort of things, that's what happened yesterday. So a lot of cash flow lenders don't want to see bank statements so they can see what commitment level you are now, not it was back then, because that's history, as I said. So a lot of lenders also want to see whether there's an ATO arrangement there being paid as far as that on the business side of things, so they can add that commitment into their proposal as well, so they can afford it, that sort of thing. So the business bank statements up to yesterday, they tell the story now. So make sure they're under control.
And that's what this panel's about, guys. So obviously you can see, Spooner's looked at it from a short-term period when we're looking at cash flow loans and things like that, whereas the other guys are probably looking at it from a longer point of view in regards to the way that the lenders and everything's assessed. So it's interesting to sort of hear it from all points. So I guess another question is, when do you think it's the smartest time to finance versus paying cash or outright for things in regards to business?
Oh, in regards to business.
When you got them.
Well, cash is king. Cash is always king.
Yeah.
So if you're doing assets and things like that, you should finance it without paying. You never know what's going to happen with the cash flow. With your cash flow, you always need to keep cash in the bank.
Yeah.
So I would say finance. If you can finance it, finance it.
There you go. It's yourself,
I think finance is good, because if you look at it over a 4 or 5 year motor vehicle loan or any equipment loan or even 7-year loan, yes, you might pay 7, 8 or 9% on there, but if you can get a better rate of return with someone like Glenn, obviously that is going to give you a better return of the money, because as you keep on paying your loan off, your interest component on that thing is lower. So that means obviously you're making more money by using your cash into an investment market and making more, rather than using your cash to buy the motor vehicle or something like that.
Yep.
So it's just a matter of looking at that. Some people don't like finance and they says, nah, I don't want to be bothered with the finance. You can't change their mind.
Yep.
But in a business, you always got to have a look at is, what do I really need going ahead?
Yep.
How much cash I need? Because if you go and spend $50,000 from your bank account today to buy a car, it is not a deduction outright. So people think, oh, I've spent it, I've now got lesser income, got to pay lesser tax. No, it doesn't change that way. So it's more about understanding how the purchase of the capital items works in the tax returns or the bottom line it affects. Yes, it eats your cash, but it doesn't drop your profit. So it's going to be
doesn't equal cash.
I'm always amazed about the bottom line. I always look at the bottom line. People pay extra money off their principal place of residence where you can't claim a tax deduction, and they don't pay it off their, they put it off in their home loan instead of, off their investment property instead of their home loan. Yeah. So investment property is a tax deduction, home loan's not a tax deduction. What structure you have it in? So I'm always looking at, okay, the affordability, your purpose in life, your affordability, and after tax costs. So where should the money go? So should I, the after tax costs, I suppose I'm looking at mostly.
Does anybody own a Saab? I just want to make sure that I'm not going to touch it.
Insult.
Insult people. So the other day I had an interview with a guy that they're sort of fairly new in business type of thing. They're on a little bit of struggle street, stuff like that. They need a new car to do their consultancy, stuff like that, but they're driving around in this rotten old Saab. But they just spent $5,000 on fixing it. So I've gone, what the did you do that for? And I said, because it doesn't add any value to it, the car whatsoever. Are you going to run out there the next day and turn the key and it's going to go? You don't know. So for around about $100 a week, which is $5,000, you could have had a new car. And they owned that Saab privately, and he's gone, oh, I can trade it in. I said, well, I'll give you nothing for it, but if you sold it privately to a Saab nut and they paid you $5,000 for it, you put the $5,000 in your pocket, there's your cash flow, there's your $100 a week for a year. So, and he's gone, didn't think of that. So they're the sort of little tips that people don't understand. So anything privately that you've got, sell that, put it in your pocket, and then finance the other stuff through the business. And then you've got a better deduction for it. Yeah. So we hope that I'm working on him. I'm trying to get him to believe it.
Is he GST registered?
Only a year though.
Ish, I'll start with you on this one. What's the difference between profit and cash flow, and why do businesses sometimes run out of cash even when they can be profitable?
Because they've bought a lot of plant and equipment as a capital items from the cash they've got sitting in the bank accounts.
Okay.
So now there's no cash left to pay for your other things.
Yeah.
I think capital purchases is really what drains your cash out. Or if you are doing a capital build or something of the investment property and people think, oh, I got enough cash, that's not a problem at all. Or sometimes you got to pay interest on that loan, could be $500,000 or $1 million, and you're not going to get rent for the next 12 months. So obviously that drains a lot of your cash out as well.
Yeah, okay. And yourself, Tom, what's your thoughts on that?
Profitability and cash flow, yeah, it's just probably covered it. It just, I mean, like the building depreciation and all that type of stuff as well. Yeah, I don't know. It's more of a accounting question.
So if somebody comes to me for a cash flow loan, generally speaking, it's just a director's guarantee. They don't normally take any security over any goods that they've got already. So where do you think the interest rate's going to hit? So have cash flow in your business. Don't borrow the cash flow if you can afford it, and then finance assets, stuff like that they're tangible and the financiers can take security over. Because if they've got security, they'll lend you the money cheaper. Whereas cash flow, just a guarantee of a director. They've got nothing they can hang on to, so therefore they're going to charge them a bit more for rate.
One of the mistakes I think people make is they think they own the cash. The company actually owns the cash. You work for that business. And even though you're self-employed, people don't look at that and go, I should just pay myself a wage, live off this wage, and then if there's cash there at the end of the year, great, take it and do what you do. That's where I think a lot of people go wrong. They think they own the cash. You don't. It's the companies or whatever you run through.
That's a very big point. Tim, I'll start with you from a mortgage point of view. How should business?
He left.
How should business owners structure their finance, personally and for business, to set themselves up for long-term success in regard to borrowing?
Talk to their accountant first.
Talk to their accountant.
Yeah. So it depends on whether your accountant wants to put you in a company, wants to put you in a trust situation.
Yeah.
What your accountant recommends. Some people run through a sole trader, and they're happy to do that. But some accountants just go, no, put it all in the trust. Some say put it in a company. You might have multiple entities, and they want to protect assets and things like that. So talk to your accountant. That's what I always tell them.
Yeah.
Or
Does that
financial
affect from a
planning.
lending point of view, you think, or buying homes and things like that?
Yeah, true. Buying homes and everything else. Some people have their own properties, depending on what industries they're in. Some people have their own homes in a trust.
Okay.
There's a trust structure.
Ish.
People do have their own homes in the trust where you are in a business which is quite risky and things could go pear-shaped at any point in time. So they don't really want to affect, technically they're not linked to the trust. Or sometimes you can have your home equity locked up for, it takes 4 years for that equity to be really locked up. That means you have another trust where you have like a promissory note kind of thing, then you lock it up. So that means then you can have your home in your own name. But I think a lot of people forget is, sometimes when they got a business name as a sole trader, it's my company, it's not a company. Or sometimes people get confused between company as a trustee of a trust or company trading in its own right with the shareholders at a trust. I think it works. It's a different beast for everyone. You can't put two people sitting next to each other in the same thing. And sometimes you gotta be very careful when even two friends come together and say we want to start the business. The first question we normally ask is, have you got a shareholders agreement? Well, how much will it cost? Well, that might cost you $1,000 or $1,500, but if you build your business tomorrow, are you happy to lose it? And it's not the first time I've seen it. I've seen it happen so many times. And going through a court case now with a client, it's been 18 months. I gave them the advice. One client came back, she says, I'm only the one interested, let's do it. Now 18 months later, I got a letter from the lawyers saying, please show us your advice letter. You recommended this, why did this client go and do it? Well, I can't change the client's mind. So they did not do a shareholders agreement. So where everything, whatever they built has to be kind of split halves. And now it's fight. Who is making the money? The lawyers.
So another,
He wasn't going to cover that.
another structure is depending again. Like I'm, I suppose I'm looking more personal. So instead of a business structure, I look at people's purpose in life and that type of stuff. But another structure I use is self-managed super funds. If you're willing to wait off until your retirement, if you've got high risks, and if you're working in a home and you can claim your rent back on your tax deduction, maybe the self-managed super funds are path to go as well, because you get the tax deductions going into super. And then the properties, you can build up a property portfolio for later in life, tax-free. Commercial property, residential property, whatever property you want.
So from an asset finance point of view, there's plenty of loans available for trustee companies, trusts, etc., etc. In a normal fact find that I'd find out, I just need to how it's all worked out, who the beneficiaries are. Under AML, we've got a anti-money laundering, that is. We've got to identify all the parties. And but as far as getting loans for assets through companies and trusts, it's not really an issue. It's just you need to talk to somebody that knows what they're doing.
We'll start with you on this one. We'll go to the lenders and then across the accountants and the planners. How do you think? How does your financial position, things like credit score, tax returns, debt, cash flow, affect the ability to grow and borrow in regards to business?
We're going to grab that in the fact find. Part of the process is we engage a Privacy Act form and driver's license, etc. And one of the first things we do is get a credit check, which is a soft touch on your credit file. It's not actually recorded. I can do that without doing that, and it gives us an idea of where you are. A lot of people forget that they've got a credit card sitting in the glove box or whatever the case, but I never use it, but it's still there and it's counted as a debt still. So there's all sorts of things like that. The credit file can actually engage us and help us with that sort of thing. Next thing is an ABN search, obviously, to find out whether it is GST registered. Some people get confused how long they've had it for. This guy was on the fight. He thought, I've got an ABN for 3 years and it's GST registered. Found out it's only a year, and the last 2 years were not GST registered. So that's a changer, that's for sure. If it's two directors, one director's score might be more than the other. Those sorts of things that can play a lot of things. All those things pushing into the melting pot and what they want to buy, how new and whether private sale or whatever the case may be, all those things are shoved in the melting pot, and that will determine where I can get it done out of all the panel of lenders that I've got, that have got all different types of appetite. So yeah, it's pretty diverse. It's pretty good fun.
Yeah, the squeaky and cleaner you are will determine your interest rate. So if you're more squeaky and clean, you get a better interest rate and you can go to a frontier lender. But if you're not, then you have to go to a second tier lender. And sometimes shit happens to people and it's no fault of their own. But they have to start again, and that's just life.
And that applies to a lot of startups. They're trying to get the equipment to get going. So they've got to skin their knees first to get the gear, to get out amongst it, and then, I've seen plenty of clients grow. Like Isht and I have worked with plenty of clients that have had to start off and pay a higher rate, that type of thing. But when they've got going and their financials going and their cash flow is going nicely, then I can get them a better deal next time. So it just grow with that client.
Issue yourself. What's the most overlooked tax deduction or financial opportunity you see business miss out on?
So what is the overlooked tax deductions?
Holiday, you should say holiday.
It's called a conference.
Expenses.
It's called a conference.
It has to be expensive.
You can say that it's a holiday, but
It's a conference.
people like to go and publish it on Facebook and Instagram. They're having a good holiday. And has anyone ever heard the tax office has got a department sitting in the background when they're looking in people's back things where they can't afford to buy and say we don't have any money. They look through everything. It happens quite often these days more than it used to happen 5 years ago. Yes, people buy cars, they forget it's depreciable, they think it's a write-off. So that's one thing people forget, that it's a depreciation. And I think your basic things like your phone, your internet are part and parcel of business. Always do an adjustment for 5-10% for private or something if it's a small little business, because obviously if you're running your business from home, you got the rest of the family. It's not about trying to put a lot of deductions. What you're really doing is you're bringing your taxable income down, and then tomorrow you're going to go and get a loan, and then the banks don't look at it that way. They say, well, you spend all that money. How much tax have you paid? You only pay tax on 40 or 50,000. You can't even afford a loan. But when you have to look at a bigger picture, to have a house, you need so much for the mortgage repayments, for the rates, water bills, family bills, food, kids raising. Work it out backwards and say how much money do you really need to live on, and then add tax on top of it and say, okay, this is kind of taxable income we need. That means at least the banks look at it in the same way, but in a different logic, to really see how things are going to work. It's not about just a deduction. I normally tell people, if you're going to go and spend $100 just to save 25 cents from the taxman, why don't you give taxman his 25 cents and still keep the $75? At least your taxable income is higher. We're going to go, unless you're going to go and spend that money is going to grow for you tomorrow. Yes, it's worth it. Go and put the money away in something like superannuation. Because at the end of the day, assuming your superannuation is looked after properly, in 15, 20, 25 years or 40 years time when you're ready to retire, at least that's a lot more money for you putting it away, because superannuation is a deduction. And a lot of people don't believe in superannuation still.
Yeah, I mean, I suppose from a financial planning point of view, I look at super as a one option of, I mean, people don't realise you can go back 5 years and put money into super and claim as a tax deduction. After 60, you've got an option of, accessing your money if you need to access your money from super as well, so you can, get a tax deduction. If you need access to your money, you can get access to your money. There's so many different structures of super. There's the self-managed super funds. I do a lot in lifetime super as well. So lifetime super, where it's only a fraction of your money counts towards the Centrelink benefits, especially with the new aged care and home care packages that came out on the 1st of November. But super is a one way if you've got the right super, and it depends if you want age pension, government benefits, or you want a self-managed super fund, whatever's your thing. But it's one way of getting a tax deduction. But people own businesses, but it's important to understand what that person wants. The owner of the business. You can have a very successful business. I've had some really big business clients, but their personal life's really poor. So you can have a successful business, but it really comes down to the person themselves. What type of life do they have?
Yeah. Last question. If there was one thing you could say to every person in this room they should start doing from today to get themselves in a better financial position for the next 12 months, what would it be?
Understand your numbers.
Yep.
Understand your costs, what you need to make to get money, what you need to earn to be able to cover all your costs, and what you need to live on without drawing. You don't need a big income. You can take it at the end of the year. But if you only need $1,000 a week to live, have $1,000 a week or whatever you need.
Yep.
So just understand your numbers, understand your debt.
Yep. Ish.
I think have an end goal in mind. When you're in a business, you need to have a goal in mind. How am I going to exit out of the business?
Yep.
If I'm going to grow the business, what is the business going to be worth tomorrow? So at least I can, because the benefit is if you've been running the business for a good 15, 20 years, you can sell your business and pay no tax.
Yeah, it's a good one.
I've done it at least 7 times in the last 20 years. I think it's more about you got to have the end goal in mind. You can't just plan 4 years before the retirement, or only run it for 4 or 5 years and say I'm ready to retire now.
Yeah,
Unless you get a lot out of it and you can pay a little bit of tax. Normally it's the longer you run, it kicks certain rules and regulations. It makes it easier, and you
Setting
get out tax free, just about.
Setting up that exit strategy for
Yeah.
the end of the business.
Yeah.
I suppose I'm a little bit different. I try to focus who am I? Who am I? What's my purpose in life? What really makes me happy? People have got happiness on 30,000 a year, and some people have got 300,000 a year and they don't have happiness. So it's diving deep and say, who am I? Who am I really? What really makes me happy? Like, general response is, I need a bigger house, I need a new car, I'll go and pay 17% interest, get a new car.
That'll.
To make me happy.
That spooner.
But,
Looking after you, has
You didn't get your normal 7 in.
but the bottom line is, I think, and it's really deep, it's really hard to find out who I am, who I really am, what does make me really happy. Like that's the secret I'm trying to work out, and that's a challenge for myself, and that's a challenge for me with my clients, trying to find out who they really are and what really makes them happy, because money doesn't make you happiness.
Not
You know, when it really comes down to deep, you know what I mean, you really got to find what makes you happy, and that's what I look at.
Any small business owners out there that are not GST registered, for God's sake, just do it. That's me.
That's yours. Excellent. Well, I
Terry's
guess we
laughing
can.
at you because more bookkeeping for you over there.
And then you make your business and then buy them.
So I guess that thing is here, we've got experts here in the room every single Thursday. You know, they've all got their different opinion on the way they do things and the way that things should be done for their industry. So I guess the thing is, ask questions, ask them. They're here. You know, costs you nothing to go and see these guys on Thursday and just ask a little question and get them dig a little bit deeper. And they're here to assist. So that was the big point of the panel today. I hope we all learned something. And thanks to the guys here for coming up and sharing with us.
And thanks to Kyle too, for the interviews were good. He's in that world as well too.
Yes.
But he's in the same